Once again, welcome you to Certified Banking Domain Professional CBDP. Now, what we're going to understand over the sessions is the basics of banking. Then we'll understand the banking jargons which are used. We'll talk about different types of banking products and banking services. We'll also speak about banking operations and regulations. In this course, we're going to touch every aspect of the banking and we'll understand how the entire bank works. We'll understand how different sectors in the bank, for example, the treasury, the retail banking products. We'll talk about the corporate banking products. Then we'll speak about the payments. We'll also understand the regulation in brief, which applies to the banking industry. Now, when we have this content being delivered, let us understand the program process. In this program, we'll have interactive sessions, meaning I'll not be talking continuously. At the end of every slide, I'm going to take a pause, ask you whether you have any questions for me. If you have a question for me, you can unmute yourself and ask that question, or alternatively, in the questions pane, you can type your questions. I'll go through the question pane and then answer all of your questions before we move to the next slide. Second point is post-program. If you have any doubts, any questions, you can of course write a mail to me and I'll share the required information with all of you. I will also keep on asking questions during the session just to understand that the concept has been clearly understood by us. In case you don't understand, then you can go ahead and put your question, as we said, either by raising your hand, typing it in your pen, or at the end of every slide you can ask your question. There is a lot to be covered in the 4 sessions starting today, so I'll maintain a certain speed, but if you still think that it is a little fast, then you can slow me down and I'll accordingly adjust the speed. The next point is session breaks. Since the session every day is of 4 hours, I'll be taking a break roughly at the end of every 2 hours. But while taking that break, I'll ensure that the logical flow is not broken. So we will complete a concept and then at a logical step, we'll take a break. When all the sessions are on, I request all of you to keep your mobile phones on silent and unmute yourself when you want to speak with me. Last point is the evaluation process. Once we have completed the entire course delivery, you will receive an email and an SMS giving you the details of the examination. You'll get the login IDs and you'll also get the passwords. You'll need to log into that examination portal. The examination is of 50 questions to be answered in continuous 90 minutes. All the questions are objective questions types and mock test would be assigned to you before you carry out the actual test. The mock test is not a must. You may skip the mock test if you don't wish to take it. The concept behind giving this mock test is to make the participants aware about the environment in which they want to or they need to attend the actual examination. Once you complete your examination, you'll get your results instantaneously on the screen. We'll also get an email from the system about the results. So this is the process of our program. Now, once we understand the process, let us continue understanding what we are going to be speaking about today. Today, we'll be discussing the basics of banking and understanding the banking concepts. This is our module number 1. In our module 1, what we will cover is introduction to banking concepts covering overview of financial markets. Then we'll speak about different types of banks, regulators and supervisors, then commercial banks and other entities in the banking field. We'll speak about banking related regulation, how banks are regulated. We'll speak about the concept of universal banking and narrow banking. I will explain different banking business lines in brief. We will understand the concept of policy rates and reserve ratios. We'll understand how to compute interest because interest is one of the major components of income of the banks. I'll introduce you to the concepts of LIBOR, the marginal cost of lending rates, the prime lending rate, and how the calculation is done in respect of interest. Then we'll speak about the foreign exchange process in the banks. I'll then move you to channels of delivery through which we give services and products to the customers. The next one is understanding the types of customers. We'll end the session with understanding the type of transactions. This is module 1. The next module is going to be deposits. So the focus will be first on introducing the banking concepts, then we'll move to deposits, then we'll move to the lendings and investments, then we'll move to risks in the banking system, and then we'll end the complete course by understanding the anti-money laundering and the FATCA related compliance requirements. This is the content of our first module. Now once we speak about the bank, let us take this step of understanding the overview of financial market. Now financial market does not mean only banks. Financial market would mean the stock markets, it would mean the insurance market, it would mean the banking sector. So financial market per se includes everything which happens across the world in the banking sector, the insurance sector, the investment banking sector, and the stock market. Now let us understand first the concept of financial market infrastructures. In the world, there are two kinds of people, and one of them is those who have money. Those who have money want to deploy this money, invest this money, and they would like to generate some return out of that investment. They may be investing this money into bank fixed deposits. They may invest this money into mutual funds. They may invest this money into bonds or securities and earn a return out of them. Some of them may use alternate investments like gold, investing in diamonds, investing in real estate, or investing even in antiques and paintings. But the basic concept with which an investor wants to invest money is to get a return out of that. On the other hand, there may be some people who need that money. Who will need the money? There will be businesses who need the money because they want to set up the business, because they want to operate the business. The governments also need the money because they want to spend money on infrastructural development. They collect the money through taxes, but the money which they collect through taxes may not be adequate. And therefore, even the governments would raise money from the public. To summarize, we'll have investors who want to invest their money, and we have issuers who would like to have access to that money, those who need that money. And then an investor may not know the issuer, or an issuer may not know the investor personally. And in this situation, we need to provide them with a platform where both the parties, those who have money and those who need money, come together. And this platform is called the financial market. Financial market is the common place where the investors will reach an understanding with the issuers. For example, Jack wants to start business. To start the business, he is going to need money. He would now approach the market, the financial market, and try to raise the money. Now, what kind of concepts would be there in the financial market? The financial market is divided into two major components: the money market on one side and the capital market on the other side. Money market means a product where the maturity of a product is 1 year or less than 1 year, which means if you invest in money market, at the most your money is invested for a maximum period of 1 year. Whereas in debt market, when you invest money, you're investing the money for more than 1 year, but it would have certain maturity. For instance, when you give a loan to somebody, or when you take a loan from the bank, there is a certain maturity period. There is a certain time period within which this loan must be repaid. So when the money is deployed and has to be given back within a certain defined period of time, that is called as the debt market, where we end up lending money or where we end up borrowing the money. The third kind of market is the equity market. When you buy equity shares of the company like Facebook or Microsoft or General Motors, the company per se is not going to return the money. For the company, the money is available permanently, and that is what is called the equity market. To sum up, money market would mean your money is blocked for at the most 1 year. A debt market would mean you're investing your money for a period of more than 1 year, but it would have a certain defined maturity. And an equity market would mean where you are investing the money perpetually. If you don't want your money back, you can stay invested in the equity. The issuer never pays the money back. So when we look at the financial markets basically are of two types: money market on one side, capital market on the other side. And the capital market is divided further into debt market and equity market. And to sum up, money market is having maturity of 1 year or less. Debt market has a maturity of more than 1 year but has a defined maturity period. And equity market is a perpetual investment. It has no maturity period. Now this is the platform where the issuers and the investors have reached an understanding that they would exchange money. This is what I would call as layer 1. Layer 1 is where they have decided that they would like to invest money into a company promoted by the issuer. Now once they have reached this understanding, the next logical step is actually paying the money. So layer number 2 is the payment layer. Payment layer means investors would now actually make the payment to the issuers. So in financial markets, we will have two layers. Layer 1 like money market, debt market, equity market, where we would have, for example, the stock exchanges, where we reach an understanding, and then once the understanding is reached, the second layer is where we would like to exchange the money, and that is the payment layers. Both the layers taken together are known as the financial market infrastructure. And for any country and for any economy to develop, we'll have the process of the layer 1 and layer 2. If the financial market infrastructures work satisfactorily, efficiently in a country, then that country's businesses will progress, that country's economy would progress, and that country will be able to develop. And therefore, the banking regulators, the insurance regulators, the stock market regulators always ensures that the financial markets and the financial market infrastructure in that country is properly working. Now banks do play a role in the financial market. They may play a role in the money market, they may play a role in the debt market, they may play a role in the equity market, and obviously they also play a role in the second layer, that is about the payment market. So these are the types of processes which we'll have in the financial market, and bank is one of the players in the financial markets. Now this is where I conclude the discussion on slide 1. Do you have any questions for me at this slide?
Hello.
Yes, go ahead.
Yeah, just one quick question. Did not understand the money market. Can you give an example? Because in equity also we can sell the share in within 1 year, right? So
yes,
money market example.
I'll give you the examples of each of the types. Money market would mean a treasury bill issued by the government. A treasury bill issued by the government is of 91 days most of the time, but always less than 1 year. So if the government wants to raise money for a period of 91 days or less than 1 year, they would sell the treasury bills in the market. If a company wants to raise money in the markets, then they would issue a commercial paper, which is again of a period of less than 1 year. So call money is another example. If a bank wants to invest money for 1 day, it would put this money into call money market, lend the money today, take it back tomorrow, again a maturity of 1 year or less. Are we clear up to this point, Kushal, that these are the money market?
Yes.
Call money, notice money, treasury bills, then so the commercial papers are the examples of money market products. Now let's look at the debt market product. In a debt market product, you buy a bond. You buy a bond which has a maturity of more than 1 year, but let us say maximum 10 years. So the payment would be made by the issuer within a period of 10 years. You take a home loan. Home loan is maybe for 15 years. So it is more than 1 year, but it has got certain defined maturity. So all loan products which have a maturity of more than 1 year, but ultimate maturity is there, that means you need to repay that money, that is called as the debt market. So government bonds, companies when they issue debentures, when you take loans, all these are debt market instruments. Point 2 is clear?
Okay. Yes.
And point 3, equity market, you said that you may sell the share within 1 year's time, but you will sell the share to another investor. If you have bought a share of Maruti Motors, or if you have bought a share of Facebook or Maruti are not going to pay you back. You'll have to get this money back from somebody else, and therefore for the issuers it is perpetual source of money. So there is no finite end for the issuers. Are we clear now on all three?
Yes, thank you.
So these are the kinds of markets we have, and as we said, the banks do play a role in money market, in debt market, in equity market, as well as they play a role in the second layer about exchanging the money, helping the parties to pay each other, and that's what is called as the payment system layer. Now having understood slide 1, let us move to the next one. Now let's understand, why do we need banks? We took a very broad example that in all these different kinds of markets like debt market, money market or equity market, the parties would come together. I am now going to take a simple example of understanding what could be the issues faced by the investors and issuers in this particular market and how the banks would then help us in resolving those issues. So let us take this example of asset transformation first. Now when we speak about assets, an individual or a business would have two kinds of assets, a real asset and a financial asset. What is a real asset? For an individual, a house, a car, the gold ornaments, diamonds are real assets. On the other hand, what financial assets would an individual have? An individual have a financial assets like a fixed deposit, a mutual fund investment, an insurance policy, an equity share. All these are financial assets. So when somebody wants to acquire a real asset, he needs money. For example, somebody wants to buy a car or buy a house, he'll need money. He may need to borrow this money from the bank, and that is where a financial asset of a person gets converted into a real asset for somebody else. For example, Arjun puts a deposit in a bank. This is a financial asset for Arjun. But on the other side, when Kushal wants to use this money to buy a house, it can convert Arjun's financial asset into a real asset for Kushal, where Kushal can now buy a house. So conversion from real asset to financial or financial asset to real asset is what is enabled by the banks. This is role number one, which the banks play. The second kind of role a bank plays is maturity transformation. That is maturity mismatch and value mismatch. Now what is maturity mismatch and what is value mismatch? I'm going to discuss that on the next slide. Let us go to the third point, which is risk transformation. Now when parties do transactions with each other, we will face credit risk, liquidity risk and market risk, etc. Again, this second point also is what I'm going to take on the next slide by using an example. And the last one is the payment services. As we said, if Kushal wants to pay Arjun or vice versa, there has to be some intermediary who would pick up the money from Kushal and give it to Arjun. The banks help the participants of the industry to pay each other. To summarize, banks have got four kinds of services available. One is asset transformation, second is the mismatch transformation, third it handles the risk transformation for us, and it handles the payment services for us. Out of these, I'm going to discuss the mismatch transformation and the risk transformation on the subsequent, that is the next slide. When a bank provides its products, the products are divided into four different types, products and services. One is a finance products. Now when a business or an individual wants to take a loan and a bank gives it, we are going to call that product as a finance product. Whenever the bank is lending money, it is financing that business or it is financing that individual. Alternatively, the bank may provide an assurance product. Here, the bank may not be lending money. The bank may not be giving any money to the customer, but the bank is giving an assurance to the customer that I would help you in case something goes wrong. And an example of such product is a bank guarantee, and an example of such a product is a letter of credit, which we are going to discuss at a later point of time. At this stage, assurance would mean that the bank is only assuring the customer that in case something happens, we are there to help you out. That is the assurance the bank gives. The third one is agency product. Here the bank acts like an agent of a customer. Let us take an example. When all of you pay your taxes, like income tax, you pay your tax into the bank. Now the bank is not collecting its own tax. The bank is collecting this tax on behalf of the government. In this case then, the bank is acting as an agent of the government. A seller may ask the bank to approach his buyer and collect money from the buyer on behalf of the seller. Then the bank is acting as a collector of the seller and collects the money from the customer of the seller. So this is another example of agency business. Third example is many times you pay your insurance premiums, your school and college fees, your subscriptions to magazines into the bank. The bank is only collecting this money as an agent of that particular party. So the third service which a bank would provide is an agency service. The fourth service which a bank would provide is the risk management service, and this is where the derivatives will come in place. Let us take a very small example before we move further. You are an exporter. You export goods today from India to United States. You are expecting $100 from the buyer. Today's rate is 65 rupees per dollar. Your buyer is going to make a payment to you after 90 days. The risk which you face, that when the buyer makes the payment, though today's rate is 65 rupees per dollar, at the time of receipt of payment on the 90th day, the rate may drop from 65 rupees per dollar to 64 rupees per dollar, and then in that situation you lose 1 rupee per dollar. This risk which you have because of exchange rate variation can be taken over by the bank by offering you a product like a forward contract. To sum up, every bank may provide at the most 4 kinds of products: financing products where we lend the money to the customer, assurance product where we tell the customer that if something goes wrong, we'll help you out. But please remember, assurance does not mean insurance. Insurance is different, assurance is different. Then the third product is agency product. The bank acts like an agent of the customer. And the fourth product is whenever a customer has a risk, the bank would take over that risk by charging him some fees to the customer. So we have 4 types of services: finance, assurance, agency, and risk management. And why we need banks is asset transformation, mismatch transformation, risk transformation, and payment services. And the mismatch transformation and risk transformation is what I'm going to discuss on the next slide. Now before we go to the next slide, do you have any questions for me on this particular slide? Okay, now we have a question from Putta. Where mutual funds fall? Are we on the earlier slide, Putta? Are we speaking from on the earlier slide about the markets? Yes. If you look at the market slide, let me go back to that slide once again. If you look at that market slide, when we have the financial markets, money market, debt market, and an equity market, what a mutual fund does, Putta, is collect money from the investors, and it does not take the money directly to the issuers. We can have mutual funds which invest in money market. We can have mutual funds which invest in debt market. We can have mutual funds which invest in the equity market. The role a mutual fund plays is collect the money from the investors and then invest that money on behalf of the investors, either in money market or in debt market or in equity market. So we may also have a combination of all this, that some mutual funds may be called balanced mutual fund. A balanced mutual fund will partially invest in debt market and money market on one side and partially invest in the equity market. To summarize, a mutual fund is actually the channel between the investors and the issuers. The issuers may then want the money for less than 1 year. The issuers may want to take a loan. The issuers may want to issue equity shares. The mutual fund will now collect the money from the investors and then invest that money in any of these 3 markets and give that money to the issuers. So like a bank accepts deposits and then gives loans out of that, in a similar way, a mutual fund will accepts investments from the investors and give it to the issuers. That is the role which they play. So a mutual fund's role is like a financial intermediary who would play a role in the money market, debt market, or the equity market, or a combination thereof. Putta, are we clear now? Good. Now moving forward, we spoke about why we need the banks, and we spoke about the 4 categories in which a bank's product could be divided. Last point on that, sometimes you may find a product which simultaneously provides more than one service. Like there could be a assurance and a finance product together. So I may provide finance and simultaneously through that product provide assurance. Now how these products work, I will define them at the time when we look at different banking products and services. So to summarize, we'll have finance, assurance, agency, and risk management products. Now to go further and understand the risk transformation, maturity mismatch transformation, we need to understand the example. Now I got 2 customers. One is Jane. Jane is an investor. Jane wants to invest an amount of $10,000. On the other hand, we have got John. John wants an amount of $10,000. Now, if you are Jane, would you lend this money directly to John? Is my question to you. Would you lend this money directly to John? Now, Putta says no. What about others? Manoranjan also says no, he will not lend. No assurance of return is what Putta says. Arjun also says no. The reasons could be, okay, so most of you are saying no. Let me explain why a couple of you may be saying no. You are saying no, number one, because Jane may not know John is one point. Even if Jane knows John, Jane may not know the creditworthiness of John. That is second point or second problem which you will have. So what this problem I'm calling is the problem of credit risk. Jane has $10,000. She knows John, but she does not know whether John will repay the money in time or not, and that is the risk of credit. That we face a credit risk. John may not pay pay the money in time to us. So she faces credit risk, and therefore she may not give the money. Let us take one more point. Jane wants to invest this money for a period of 1 year, but John needs this money for a period of 5 years. This is what I will call as maturity mismatch. That she has money, the amount needed by John is also identical, but the time for which John needs this money and the time for which Jane wants to invest this money do not match. This is called maturity mismatch. The second point we spoke about risk. Jane does not know whether John has the necessary capacity to repay that money. This is called credit risk. So second kind of risk which comes in this transaction is the credit risk. The third point, here we have taken identical amounts. Jane wants to invest $10,000. John wants to borrow $10,000. But it is possible that Jane wants to invest an amount different than $10,000. Maybe more, maybe less, maybe $15,000, maybe $7,000, and John needs only $10,000. This is what I would call as the amount mismatch. The amount the investor wants to give is different than the amount which the issuer wants to receive. Now we have spoken about 3 points. One, there is a risk in lending money to John because John may not be able to repay the money on maturity. Let me add one more component. It is also possible Jane wants the money prior to maturity. John may not be able to furnish it. So on maturity or before maturity, John may not have the capacity to repay the money. This is called credit risk. Second point, Jane wants to invest money for 1 year. John wants it for 2 years. This is called the maturity mismatch. Again, the deal would not happen. Jen wants to invest an amount which is different than $10,000, more or less, 8,000 or 15,000, but John needs 10,000. This is called the amount mismatch. Again, the deal would not happen. So because of such reasons, Jane may not want to invest and give the money directly to John. And that is where we need an entity in between, like a bank, who would accept a deposit from Jane, irrespective of the maturity mismatch, irrespective of the amount mismatch, and John can still approach a bank and then take that loan. So what a bank does, that the bank is helping Jane to handle these three risks: the credit risk, the maturity mismatch issues, and the amount mismatch issues. Now let us look at the problems from John's side. If you are John, would you borrow money directly from Jane? Now you would still have the similar problem. You do not know whether Jane will be able to produce the money when it is needed. Number one. What if Jane wants the money back before the maturity? Is another problem which you will face. So in such a case, both Jane and John would have a problem. Do we clearly understand the problems faced by Jane and John, and because of which they are unable to carry out the transaction? They may do it, but then there are risks associated with it. Are we clear about those problems if they do the transaction directly? Good. So having understood the problems, let us move to the next point of then how would we actually tackle these issues. So let us take the example further. Now we had Jen and we said Jen wants to invest the money for a period of 5 years. So let us take this example. 5, 10 and 15. on the screen indicate the time period, that is 5 years, 10 years and 15 years. Jane places a deposit of $10,000. Now question number 1, when Jane places a deposit for $10,000 for a period of 5 years, and at this point of time on the screen you have no borrower, but at the same time, since you have accepted this money from Jane, you must start paying her interest at the rate of 7% per annum. What would you do with this money is my question to all of you. I'll repeat the question. Jane has given a deposit of $10,000 for a period of 5 years at the rate of 7%. You have no borrower at this point of time in your bank who wants to take this money. What will you do with this money? Because if you keep this money idle, you will end up incurring a loss because we have to pay interest to Jane, but there is no income from the other side. So the question is, what do we do with this money? Right.
The bank will have to lend it to somebody, right?
Perfect. So right. So we invest this in money market is Putta's example response. Very right. That we can't keep this money idle. Now this is how the investor will come to the money market. I got this deposit from Jane. I got surplus liquidity. I have no borrower. As a bank, I will go to the money market. Look at the time period for which I would need to invest this money. I may invest this in call money for one night, overnight. I may invest this in notice money. I may invest this in mutual fund. I may buy bonds for investment for a few days, and in this way my treasury would understand the amount of surplus which a depositor has generated. I have no avenue of deployment through lending, and in such a situation I will go to money market or debt market depending on the time period for which I have this surplus, and then go ahead and put that money in the money market. So all of us are clear as to where would a bank enter into the money market as the investor when we have got surplus and we have no avenue of lending it to somebody else. Now once we have put this money in the money market, at some point of time we get an application from a borrower called John. John has applied for a home loan of $10,000 and we are willing to give it to him for a period of 15 years at the rate of 10%. Now we have already put our money in the money market. We will sell our investments if we have made them in the money market, generate that money back, bring it back to our bank and give this home loan to John. Now we need to understand one thing, that in this transaction there is no amount or value mismatch. Both of them have a transaction of $10,000, but in reality it is possible that the deposit is of a different value and the loan is of a different value. And if there is a difference, that means if the deposit is more than the loan, we may put this surplus in the money market. For example, the deposit is of $15,000, the home loan is $10,000, we have got surplus $5,000, we may invest this into the money market or the debt market or the equity market. On the other hand, the home loan requirement is of $15,000, the deposit is of $10,000, the shortfall of $5,000 may be generated by us by borrowing the money in the money market, by borrowing the money in the debt market, or by selling our investments and generating that money. This is how the mismatches in the value will be handled by the bank. Now we have spoken about the value mismatch. Let us understand the second point, which is the timing mismatch. Jane wants a deposit to be given for 5 years. John is not going to repay the loan in 5 years time. So at the end of the period of 5 years, how do we repay Jane is one question which we have in our mind. So ball is in your court. How will we repay Jane at the end of 5 years, because John is not going to repay his loan in that time?
Maybe they will look at some other loan which was supposed to get
Mature.
repaid by some other person in 5 years.
Correct. So that means you need to look at another source. So one way to look at it is to get another party giving the money. It could be a borrower repaying a loan taken earlier, or we may look for a fresh depositor. Am I right?
Correct.
Yeah. So Putta, I'll answer your question in a while about the money investment, but I want to introduce one more concept, is the net interest margin. Now in this whole transaction, the bank is managing various risks. For Jane, credit risk, then maturity mismatch risk and the value mismatch risk, and for which the bank is charging a difference of 3%. This difference of 3% in the banking parlance is called as the net interest margin. We are earning interest of 10%. We are paying interest of 7%. 3% is our net interest margin. Now let us look at the question which Putta has before we go further. How effective money investment can help for issuer for investment of a short period of 1 day. Putta, in a bank, there is a department or a committee called Asset and Liability Management Committee, ALM. The ALM committee has to continuously monitor the surpluses generated or shortfalls expected. And when we look at the ALM, for next 5 to 8 years, the bank will map on a periodical basis how much is the surplus in future which they are expecting and how much is the shortfall in future which they are expecting, and accordingly manage the liquidity with the bank. So one requirement is manage the liquidity in the bank. Second requirement is also stay profitable, because I cannot invest the money at a lower return than the rate at which I have accepted the deposit. For example, when I put the money in money market, if I'm going to get a return of less than 7%, I lose because I'm paying Gen 7%. If I get a return of 5%, 2% is my loss. So usually we would try to ensure that we get more than 7%, but I use the word usually. That means every time this may not be possible. So if it is not possible, we'll still invest. So the effectiveness would depend upon what kind of risks are we trying to manage. And when we look at the investment being made, we'll have different kinds of risks. So I'll complete this slide and revisit your question of what are the risks to be managed when we approach the money market. So I was telling you that when we want to repay the loan to Jane, we must get some other source, and one source which Kushal spoke about was getting the loan back from some other borrower provided it is due. Alternatively, source a deposit from somebody else. So in this example, I am sourcing a deposit, a fresh deposit at the end of 5th year from Bob. Now what I'm going to do with this $10,000 raised from Bob is to use this money raised from Bob to repay Jane. So how we are managing the mismatch in the timing is Jane at the end of 5th year is expected to be repaid by taking a fresh deposit from Bob. But when we do this, we still have a couple of problems. Let us understand problem number 1, which is on the screen. So when the problem number 1 on the screen is when we accept this deposit from Bob, it is possible that Bob has to be paid interest at a different rate than what we have been paying to Jane. If Bob is going to be paid interest at the rate of 8%, in that case, my net interest margin will drop from 3% earlier to 2%. I will gain only when I am paying less than 7% to Bob. But this is the risk which I cannot foresee, or this is the problem which I will have when I accept a deposit from Jane. The problem then is that at the end of 5th year, when I accept a fresh deposit, what would be the rate of interest? If the rate of interest at the end of 5th year is more than 7%, my bank is going to lose money because there will be a reduction in the net interest margin. This risk which the bank faces is called interest rate risk. In the interest rate risk example we have had, my profits will go down because of increase in the rate of interest of deposits at the end of 5th year. Are we clear about problem number 1 when we accept this deposit from Bob? Good. So this is point 1. Let me ask you one more question. What if we accept a fresh deposit from Bob and Jane does not take her money back? Jane renews her deposit. Then the problem I would have in the bank would be I would have $10,000 from Jane, an additional $10,000 raised from Bob. I have $20,000 and I again have to look for a new investor, a new issue, new buyer, new borrower who would be taking this money from us. So when we accept a fresh deposit, does not necessarily solve our problem, because it is possible that Jane may renew her deposit. So when we accept this deposit from Jane, now I've got 2 issues. One is the interest rate at the end of 5 years may change. Two, Jane may roll over her deposit, or I do not get a deposit from Bob. These are the risks which the bank is handling, which I am calling as the maturity mismatch related risks. Are we clear up to this point? Great. Now let me go back to another issue, and then I'm putting all your questions on hold. I'm able to see them, but I'm not answering them at this point, only because I will cover all the risks and then address your issues. Now let's look at the next point. The next point, what risks does the bank face if Jane or Bob want to withdraw the deposit before maturity? Now John is not going to pay us back before completion of 15 years, but if Jane and Bob demand the money before maturity, for example, Jane has assured us that she will not take the money back before 5 years, but at the end of third year, Jane says that she wants the money back. We will have a liquidity crisis at the bank. We have no money because everything has been paid to John, and if Jane demands the money beforehand, we have this liquidity problem. That is the risk which we face if either Jane or Bob want to withdraw the money before maturity. So we again have the liquidity issue at the bank. Now we also will have a risk if John prepays his home loan. John has deployed his money for 15 years, but at the end of third year itself, John repays the loan. We are again back with excess money in our hands. Then we have another issue. If Jane places a deposit in US dollars and John takes a home loan in sterling pounds, we have the currency mismatch and we have the exchange rate related risks. Now to summarize, what we have talked about is that when we accept a deposit, there could be a timing related issue, there could be an amount related issue. Jane may want her money back before maturity, which will create the liquidity risk at the bank. John may prepay the loan before maturity. This will again create liquidity risk at the bank. Jane's deposit is in different currency than John's loan. This creates the exchange rate risk in the bank, and the interest rates keep on changing in the market. This creates the interest rate risk in the bank. To sum up, I spoke briefly about liquidity risk being created because either Jane wants the money back before maturity or John prepays the loan before maturity. Jane extends her loan, John defaults on his loan. All this will result into liquidity risk. If the interest rates change in the 15 years time, this will create the interest rate risk for the bank, and if the deposits are in different currency than the loans, we will have the exchange rate risk. To summarize, we spoke about three risks: liquidity risk, interest rate risk, and the exchange rate risk. Are we clear on all the three risks? In this single example,
Hello.
yes, go ahead please.
Just one quick question. So when we say liquidity risk, maybe a little confused as to is it like saying that bank has excess money which they cannot deploy somewhere?
It could be looked
For
at
example,
in both ways. Bank has surplus money and it is not able to deploy. That is what I will call as reinvestment risk. You take this money
okay.
and you are able on a, when you accepted the deposit at 7% and now you are going to deploy it at less than 7% because of market changes, then this is reinvestment risk. Are we clear, Kushal?
Yes.
Yeah. So reinvestment risk got created because of excess liquidity. So surplus liquidity could be a problem, short liquidity could be a problem. So what are the risks involved? Liquidity risk, exchange rate risk, and interest rate risk. There is one more risk here in this transaction which I am separating, that is John not paying his loan back in time. I called it as a default by John. That is credit risk. So this single transaction now has liquidity risk, interest rate risk, exchange rate risk, and liquidity risk, and the reward for these risks is that 3% net interest margin. So why does that bank want the spread? That 3% is to handle interest rate risk, exchange rate risk, liquidity risk, and credit risk. Are we clear? Then I'll go and answer put task questions. Are we all clear? Please confirm. Only Arjun is confirming, the others are not. Great. Now having understood, let us go forward, and the question from Putta is how effective money investment can help for issuers for investment of such a short period of time. Now Putta, the answer to this question is I may not be every time making a profitable investment, but if I am able to handle my liquidity, if I am able to handle my exchange rate risk and get at least something in return, that would be reducing the possibility of losses. So if I don't do anything, then I may lose the amount completely, then I would at least be able to get back something. So effectiveness would depend upon the market situation. Let us take a small example to understand this effectiveness of market. You have Jane give a deposit at 7%, and we said one of the problems is that Jane wants the deposit back before maturity. That means she wants it instantaneously, and at that point of time we can't ask John to give this money back, and we may not have a Bob to give us a fresh deposit. In such a situation, I will rush to the money market and raise the money at whatever interest rate it is available in the market, because I cannot say no to Jen. I must satisfy Jen, because the moment I say no to Jen, my reputation in the market would suffer. So even if in the market the money is available at 10%, I would still pick up that money at 10% and close the deposit of 7%. I am losing 3% in all this. But I am managing my liquidity risk and I am managing my reputation. So effectiveness purely may not be quantifiable in money terms. Even if I incur more cost, I am managing my liquidity and I am managing my reputation. So cost may be more, cost may be less, but the risk has to be handled by the bank. Are we clear on point number 1, which is how effective money investments can help? Yeah. Point 2, issuer in money market is big institutions like banks only, or any other institutions also participate? In money market there are a huge number of players. The money market players include the governments. As we said, government issues treasury bills, then it is there in the money market. We'll have the banks playing a major role. We have insurance companies. They collect a lot of premium and they want to deploy this premium, collected premium, for investment purposes in the money market. We also have pension funds and mutual funds who also invest in the money market, whatever short-term liquidity is there. So all big players like banks, like governments, like business houses, like mutual funds, hedge funds, pension funds, all such big players, whenever they have temporary shortfall of liquidity or temporary surplus of liquidity, will come to the money market. Putta. Now are we aware of who else could be there in the money market? Good. Now I am moving to the point of ALM. We discussed very briefly ALM, and I am not going to discuss that in detail at this juncture. We will discuss this in detail when we go to the risks faced by the bank. But what is ALM? Now bank has an asset on the screen which is a loan given to John. An asset because it will get this money back from John. It has lent the money. They own this money which is given to John. So we have an asset. On the other hand, we have a liability which is a deposit accepted from Jane. So what the bank has to do, they manage the assets, balance the assets which is a loan to John with the liability of a deposit from Jane in such a way that we have no liquidity crisis, we have no exchange rate issues, and we have no profitability issues. That means the interest rates also must be managed properly. So when a bank receives a deposit and deploys the money in loans, it has to manage the liquidity, it has to manage the interest rates, and it has to manage the exchange rate risk. All this management together done by the bank at the treasury level of the bank is called as the asset and liability management. Now imagine a very large bank like Citibank or HSBC or an Indian bank like State Bank of India receiving deposits continuously throughout the day and paying out loans throughout the day to many borrowers, profitability, and they do not incur a loss because of exchange rate fluctuation. Doing this activity at the treasury level continuously is called the asset and liability management.